All right, welcome to this explainer. Today we're looking at a massive macroeconomic shift that is quietly unfolding right under our noses. A shift that literally threatens the structural foundations of the European economy and, by extension, your own personal wealth. We're going to unpack a super detailed analysis of the current industrial crisis in Germany, and we're going to do it by stepping right into the shoes of a wealth manager. We need to evaluate exactly what this geographic concentration risk means for you. Because, look, we aren't just reading the news here. We are actively hunting for the warning signs of a collapsing superpower and figuring out exactly how to insulate your savings from the fallout. Okay, let's dive right into this. 100,000. Take a second and just let that staggering number sink in. That is the number of jobs Volkswagen is looking at cutting. To put that into perspective, we're talking about potentially letting go of 1 in every 6 employees across their entire group and permanently shutting the lights off in 4 different German factories. I mean, the company that literally put Germany on wheels, the people's car, is facing an absolute crisis. But as you'll see, the day a giant falls is really only the last page of the story, definitely not the first.
So to understand how we actually got here and what it means for your portfolio, here's our roadmap. We're going to cover the fall of the German giant, symptom versus real cause, the domino effect on Italy, the demographic trap, and then wrap up with how to protect your savings.
Starting off with Section 1, the fall of the German giant. You know, the sheer scale of this crisis is just unprecedented. Back in March, Volkswagen published financial numbers that sent absolute shockwaves through the market. Their operating profit crashed by 53%, down to 8.9 billion euros. We literally haven't seen margins squeezed this tight since the infamous Dieselgate scandal in 2016. And over in China, a market that had been their absolute goldmine for 20 solid years, they've been pushed down from first place to third, overtaken by brands most Europeans couldn't have even named a few years ago. But here's the thing. This isn't just about one car manufacturer. It's a complete avalanche across the entire supply chain. Bosch, the guys making the brakes and sensors inside practically every German car, announced 22,000 job cuts. That's the biggest cut in their 140-year history. ZF is cutting up to 14,000. Continental and Porsche are slamming on the brakes. Since 2023, 55,000 jobs have just vanished from the German auto sector. And the bleeding definitely doesn't stop at the factory gates. These historically wealthy automotive cities, like Wolfsburg and Stuttgart, are watching their tax revenues completely plummet. They're actually being forced to cut basic public services, from fixing roads to keeping community pools open, just to keep their heads above water. Now, what's really interesting about this slide is this exact quote from Oliver Blume, the CEO of Volkswagen. When he presented those crashing profits, he said, "High costs are the symptom, not the cause." I want you to keep that phrase in mind. It is absolutely crucial. It's the key to understanding why this massive economic engine is stalling out. It forces us to ask, well, if costs are just the symptom, what exactly is the actual disease killing the German industrial giant? Which brings us to Section 2, symptom versus real cause. To diagnose that disease, we really have to look past the surface-level headlines about losing cheap Russian gas. Okay, on the left side of the equation, yes, you have the symptom, high energy costs. For decades, Germany's whole model relied on cheap Russian gas. And today, German industry is paying roughly double for electricity compared to the US. But look at the right side. That is the true root cause, the stubborn refusal to change. Volkswagen knew electric vehicles were coming way back in 2015, but German executives basically dismissed EVs as toys. Why? Because their profit margins on traditional diesel engines were simply too comfortable to let go of. It is the exact same mistake Siemens made 20 years ago when they brushed off mobile phones as a passing fad and clung to analog switchboards while the rest of the world just moved on without them. They didn't have a cost problem, they had a product problem. And this brings us to a really fundamental economic law, coined by Joseph Schumpeter, creative destruction. Basically, true economic growth inevitably destroys the old to make way for the new. Empires and companies fail when the people at the top try to block this natural process, just to protect their outdated champions. Think about the Republic of Venice 700 years ago. They built this immense wealth through a social mobility contract called the Commenda. But once the elite got rich enough, they panicked. They literally locked the gates and banned the contract to protect themselves from any new competitors. Venice stopped growing and slowly turned into the beautiful floating museum it is today. Germany is doing the exact same thing right now by stubbornly defending the diesel engine instead of embracing the future. Let's look at Section 3, the domino effect on Italy. Look, in a hyper-globalized economy, a crisis in Wolfsburg hits very, very close to home.
Industrially, northern Italian regions like Lombardy, Veneto, and Piedmont are deeply, heavily integrated into the German supply chain. When Germany stops building cars, it's the small and medium Italian supplier enterprises, the piccole imprese forniture, that instantly lose their orders. Strategically, we're watching major assets change hands. Pirelli, the totally iconic Italian tire manufacturer, now actually has a Chinese state-controlled giant, Sinochem, as its largest shareholder. And financially, well, this hits your bank account directly. The German Bund is the benchmark for the Italian spread. If Germany weakens and has to take on unprecedented debt, that spread moves. A weaker Germany means a weaker euro, a highly pressured European central bank, higher variable mortgage rates for Italian homeowners, and the very real threat of a technical recession for both countries by 2026.
Moving to Section 4, Acquisitions and the Demographic Trap. You see, when a superpower stumbles, there is always someone with very deep pockets waiting patiently in the wings to buy up the pieces at a huge discount. The roles have completely reversed from that Venetian era we talked about. Today, new global powers are buying out the old European champions at their absolute weakest moment. Look at Mercedes-Benz, the ultimate symbol of German engineering. Nearly 20% of it is now owned by Chinese entities. KUKA, which was the absolute crown jewel of German industrial robotics, was acquired by a Chinese group. Volvo has been Chinese-owned for years now. When European companies run out of liquidity, foreign buyers eagerly step in to keep the factory gates open.
So the really crucial point here is that this industrial decline is happening at the exact same time as a ticking demographic time bomb, 1.5. That number is honestly terrifying for the future of the European welfare state. By the year 2050, projections show that in Italy, there will be fewer than 1.5 working-age people to support every single retiree over the age of 65. The entire pension system is built on one simple pact: today's workers pay for today's retirees. When your workforce shrinks drastically, that pact simply breaks down.
Finally, Section 5, How to Protect Your Savings. So all of this macroeconomic data, it isn't just a history lesson. It is a massive, flashing red warning sign for your personal wealth. Let's put on our wealth manager hats for a second. The single biggest enemy to your portfolio right now is confirmation bias. It's this psychological trap where we believe that just because something was super dominant in the past, it's going to be dominant forever. For 20 years, we've treated Made in Germany as an absolute guarantee of solidity. As investors, we naturally suffer from home bias, heavily concentrating our money into Made in Germany or Made in Italy assets, simply because they feel familiar and safe. But clinging to familiar national champions that refuse to innovate, that is the financial equivalent of the Venetian oligarchy locking their gates. You are literally trapping yourself on a sinking ship. To actually insulate your wealth, you need to follow these rules of risk mitigation. First, recognize and actively avoid that home bias. Just because you know a brand name doesn't mean you actually understand its risk profile. Second, abandon single sector or single country loyalty. Putting all your money into the European auto sector or European sovereign debt is a highly concentrated risk. And third, and absolutely most importantly, diversify your investments globally. Look, your goal as an investor isn't to magically guess who the next global superpower will be. Your goal is to spread your capital widely enough so that when one giant falls, your life savings don't get crushed underneath it.
Because at the end of the day, the true risk isn't just that Volkswagen is cutting 100,000 jobs. The true risk is that you might have unknowingly tied your entire financial future to a factory that is stuck in the past. So I'm going to leave you with this final thought to help you evaluate your own asset concentration. Is your portfolio stubbornly defending yesterday's champions, or is it actively investing in tomorrow's? Think carefully about where your money is sitting right now, and we'll see you in the next explainer.